In this video, we're going to talk about individual retirement accounts. Now, an individual retirement account, or an IRA, is a very important investment vehicle and one of the options to us if we want to invest or save for retirement. So an IRA is simply a special retirement account that allows you to put a portion of your income into investments as a way to grow that money so that you have it later on. Now, this is very similar to a 401k or 403b in terms of the actual concept of it, but with IRAs, there are a couple of different types. So what we're going to do over the course of this video is we're going to break down two of the most common types of IRAs. So those types are what we call a traditional IRA and a Roth IRA. Now, there are a lot of similarities between these two types of IRAs, but there are some pretty significant differences that might make one a slightly bit more advantageous for your personal financial situation compared to another. So we know that both of these are investment accounts that are designed to be a resource for us to be able to put money away, to invest in things, and grow that money later on. How they do that is a little bit different, but first let's start with some of the different commonalities between these two types of investments. Now, the first commonality between these types of investments is the amount that they allow you to contribute annually. Now, currently, as of this video in 2019, the maximum annual limit to contribute to an IRA is $6,000. Now, this means that over the course of the year, you can essentially contribute $500 monthly if you choose to kind of accumulate payments over a monthly period of time, or if you choose to do lump sums, the amount of those payments, regardless of the frequency, within a year's time, so from January to December, so we're talking about a tax year, cannot exceed $6,000. And so that's the maximum amount we can contribute to these types of accounts. In addition to the ability to contribute $6,000 annually, both traditional and IRAs also give you access to a lot of different investment options. Now, a common misconception with IRAs in general is that they are the investment in themselves. In reality, they are an account, and underneath that, or within that rather, you can incorporate a variety of investments. And so if you want to include mutual funds in your IRA, or individual stocks, or ETFs or index funds, bonds, you can include those in your IRA. And so it is not an investment in itself, but it is the ability to include investments within this one vehicle. So you could technically have an IRA and invest in bonds or mutual funds or a variety, depending upon what your investing goals and objectives were. Now, past this point is where both traditional and IRAs get a little bit different and where some of the uniqueness, kind of applies. So one of the biggest differences between these two types of investment accounts is how they handle taxes. So first, starting with the traditional IRA. With a traditional IRA, the contributions that we make into our IRA account, or IRA rather, are tax deductible. Now, what this means is when you are filing taxes at the end of the year, you commonly have to report what we call AGI, or adjusted gross income. And then you either take the standard deduction, or if you are single and have more than $12,000 in deductions, or married and have more than $24,000 in deductions, you can itemize, which means you can list all your individual deductions. So hypothetically, let's say you have a adjusted gross income of $75,000 and you contribute the maximum amount into your IRA, which is the $6,000. Well, that'll reduce your adjustable gross income, or your taxable income, to $69,000. Which means now you're going to pay less in taxes at the end of the year. So you potentially can go into a lower tax bracket. So there can be some very big financial implications in the short term that might be helpful to you, and maybe an additional incentive to put your money into a traditional IRA, knowing that you're not only getting a benefit in the future, meaning your retirement is growing and you're going to have money to access later on in life, but you're also getting an immediate benefit, right? You're reducing your taxable income and thus reducing your tax liability as well. Now, A couple things to consider with regards to traditional IRAs is there are income limitations. So I'm not going to get into the specifics, but if you make above a certain amount of money, I believe for single it's around $133,000. Married, filing jointly, it's somewhere in the $180,000, $190,000 range. But if your income goes above that, then the tax deductible kind of component to it starts to go away. So that's one thing to look at. If you're a higher income earner, you might want to look at the specifics to make sure that if you want to use this investment vehicle, that you still can kind of get that benefit. Now, with a Roth IRA, we actually do not receive any tax deductions with our contributions. So in the same example, if you were to have an adjusted gross income of $75,000 and you contributed $6,000 into your IRA, your deductions or your AGI would still stay at $75,000. And so there is no benefit from a tax standpoint, at least at the beginning. And that's because contributions in a Roth IRA, your earnings grow tax-free. Now, what this means is while you will forego the tax benefit in the present time, when you get to the point to where you're going to withdraw your money, you're actually not going to have to pay taxes on the earnings. And so the maturity and the growth of those investments, you're going to have tax-free, which is kind of a really, really cool thing. And why many people are kind of gravitating more towards Roth IRAs because they might not need the tax benefit now, and it might be more advantageous to have the money tax-free later on where you're taking withdrawals and you're not having to claim that as income. That's a very significant reason a lot of people go with the Roth IRA. Now, a couple of other differences, and then we'll kind of talk about some things you should consider when selecting either one of these. But a couple additional things to consider with these particular investments has to do with your ability to contribute. So with a traditional IRA, you can actually contribute until the age of 70 and a half. Once you get to 70 and a half, you can no longer contribute to your IRA. Now, I know I mentioned that your annual contributions can be $6,000, but if you're past the age of 50, the government allows you to do kind of an accelerated or catch-up contributions. So you can actually increase your contributions once you are in excess of 50 years of age to currently $6,500. So you can contribute more if you are maybe starting to save later on in life for retirement and need to maybe catch up and grow that money a little bit more quickly. That gives you the ability to do it, albeit not really that much, but it's certainly better than not contributing anything at all. Now, with a Roth IRA, you can actually go ahead and you can totally contribute when you get past 70 and a half. So if you want to keep contributing to your IRA, maybe you're going to use it potentially in some kind of financial planning and gifting to children or someone else, you can continue to contribute if you would like to. So that's one of the significant benefits of Roth IRAs is you can continue to make those contributions past 70 and a half years old. And then, of course, you can get access to the proceeds at 59 and a half is when you can begin to kind of withdraw on that IRA. Now that you know some of the differences between these, and there are certainly some additional ones that get very specific, but these are kind of more the general differences that most people consider when they're deciding to go with a traditional or a Roth IRA. You got to think about what's right for you. There's a couple of things to think about. One of the biggest differences, of course, is this tax deductibility piece. So one of the things that might be helpful to think about is if that is advantageous for you now versus later. The common method of operating for going with a Roth IRA is you have the belief that later on in life, you're going to earn more income and will thus need the tax benefit later. So it's very common that as people kind of age and you get it settled into your career and your income increases, that your income is going to continue to go up. And for most people, you kind of get into your prime earning years in your 40s. And so at that point, it might make sense as you get closer to retirement and your income is very high to take the tax benefit versus if you did not, then you would have to claim that as additional income and that could increase you into a new tax bracket. The other thing is maybe you're a higher earning income individual now, and maybe the delayed tax benefit isn't as significant to you as reducing your adjusted gross income today. So that's one thing to really consider, is you might need the tax benefit now to reduce your taxable income versus later on. Regardless of which particular IRA you choose, the important thing is to just make sure that you're making the right choice for your personal financial situation. So considering the benefit of taxes, and then obviously considering whether or not you would like your money to be able to grow tax-free later on, are some of the important things to consider. What I personally recommend is, if you are still kind of trying to figure out the details of it, might be helpful to meet with a financial professional, even someone like a CPA or accountant or a licensed financial professional can help you kind of walk through the particulars, and because every situation is different, can help you make the right choice for what will help you. Another option, just as we kind of close this video, is you can do a combination of the two if you would like. So if you want maybe partial benefit of tax treatment, partial benefit of growing tax deferred, you could have both the traditional and Roth IRA. One thing to consider, though, is that you're still have to follow that $6,000 annual contribution. So if you split the difference, you'd be able to contribute $3,000 into your traditional IRA and $3,000 into your Roth IRA. So one thing to keep in mind. Another thing to keep in mind is you can open IRAs into different names, and not your own name, right? You can only have one for you, but your spouse, you can have an IRA in their name as well, and also have the ability to save and have a new tax limit as a result of that. So additional things to consider, but those are some of the basics regarding traditional and Roth IRAs, and hopefully that was helpful for clarifying some of the significant differences and maybe getting you a little bit closer to figuring out which one might be the best for you. Hey, thanks for watching this video. If you enjoyed it, I encourage you to like or share, and also be sure to subscribe to Alanis Business Academy so you can get updates on the latest content. Make sure to enable notifications too, so you're notified exactly when new content hits YouTube. Thanks for watching.